All right, so was this week the calm before the storm? Really kind of a quiet week, ups and downs, but on an intraday basis and within a relatively tight range. Is that the calm before the storm of the last full week before the election? We've seen in the past that that's been a pretty bearish week. At least it can be, especially in an election with a lot of uncertainty. Um, and then, of course, going into election, once we do get a result, then things are okay. And there's a very good opportunity of that type of pattern playing out again. So I'm going to break down what that could look like and how to anticipate it and what we can do about it. How we can trade stocks that might look bullish by themselves, but still account for potential weakness from a macro environment standpoint that can impact that type of bullish trade directionally, and kind of try to find stocks with good margins of safety we've talked about before, but also don't have necessarily that same upside directional opportunity. Not just because of the macro environment, because of potential resistance. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, October the 23rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast on the S&P 500, as they always do. And we'll see that the intermediate line here continues to fall slightly. And as a result, we have light pink shading on the chart. But we have the green line. In fact, that moving average is really kind of starting to rise up pretty nicely there. In fact, if the intermediate line turns back up, it'll be dark green shading a green line just like that. And if you see here, again, after the pullback, when we rallied back up through the Fibonacci retracement zone back above the 78% line, to the point where we start a new leg higher, and we did get dark green shading the green line, so things are looking really good there. But as we mentioned before, we couldn't hold that 78% level, and we came back down into towards that retracement zone, and been kind of languishing around there so far. So to get back to where we're dark green shading the green line again, we feel really good about it. We need to get kind of back above the 78% level, get above pretty much last Monday's high point, Friday's high, and really clear that and stay above it and really get going. Obviously, we already have the green line, and at that point, we'd most likely have dark green shading as well. Short-term sentiment looks pretty good here. Obviously, the intermediate line is still above the market sentiment line, even though it is falling. So we're not as bearish as we could be. In fact, I think you kind of need to break through this 34.25, 34.30 level we've been talking about before we really get significantly bearish. And obviously, we'd have to break below the moving average, and that's still a possibility. And actually, in my opinion, the most likely outcome, especially over this next week heading into the election, where the election cycle, the news cycle will just be filled with uncertainty, and that typically leads to volatility. So that's a possibility. You can see short-term sentiment is higher, but not quite into the reversal zone, just kind of a smidgen on both of them. So we'll see if that stays that way going into the new week. You can see not so bullish in the short-term sentiment on the Dow Jones. It's definitely not that bullish on the NASDAQ. In fact, the NASDAQ is actually still below, short-term sentiment still below, and this intermediate line is falling pretty sharply here. And you can see, again, after clearing just barely the 78% level, we are back into the retracement zone, the upper half of the retracement zone. But we are back into that. Keep an eye on that heading into the new week as well. It's been the most bearish index, the NASDAQ. Incidentally enough, the Russell 2000 has been the most bullish out of all of these. And look, it got an overbought cluster. All the lines up above 80, except for the market sentiment, but all the other lines up above 80. That led to some weakness previously when you kind of had an upward move and then sideways action that culminated with a cluster and we fell. Here's an upward move, sideways action, potentially culminating with a cluster. So we'll see if that ends up playing out to be something more bearish. Usually at the beginnings of intermediate runs, especially when the intermediate line just barely gets above 80, when you get a cluster in this area, that's a really good sign. I don't know necessarily if that's a good sign here. Again, we've seen this play out already before on this current move off the COVID lows. And the last time, like I said, that led to weakness down, and we'll see if that ends up being the case here. Again, that would play into this, again, the overall theme that that this last full week before the election in the past has been pretty bearish, and we'll see, at least in the most recent past, with the elections as uncertain as they, seemingly getting gradually more uncertain as from one to the next. So the last one being, and really there wasn't a whole lot of uncertainty in that week, but still, the news cycle produced volatility, and that's what we got. And you would expect the news cycle to continue to produce volatility here going into next week. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. If you do like our videos and you want to let us know, you can do it with one click right now while you're watching down there. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions do you have? What comments do you have about anything I covered in the video today? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, we invite you to check out some of these other things over here on our page, including our Market Outlook live video. So every day I do a Market Outlook video. I also do a live video that same day at 3:30 Eastern Time. So we review all the old Market Outlook trade ideas. We continue to manage them, all the ones I told you about getting into. And anybody can tell you to get into a trade, but not everybody continues to talk about how to manage that trade while you're in it until you close it, and even tell you when to close it. And that's what we do in these videos here. We also, and a lot of everything we do is kind of a representative of what we do in our classes, of what we teach in our classes, different trades that we put on in our classes there. And that's over here on our calendar. You can see the classes we have coming up. Also come down here, click on this heart, opens up this new window here. Hit that like button. Also hit this thumbs up icon, also opens up a new tab. Hit that like button there. Again, the more often you do that, the more likely more of our followers will see our content because it has likes and engagements from you. So we really appreciate that. It also benefits you because Twitter and Facebook will promote content in your timelines when you log in from the accounts that you engage with the most first, so you can see it. And so we try to make it really easy for you to engage with us here. All right, now let's take a look at the weekly chart for the market forecast. Let me bring up the weekly for the S&P 500, and you can see a little bit of a down week here after a 3-week winning streak, coming down with a down week here. Short-term sentiment dropping, but nothing too significant. You still got strong, dark green shading and a green line, but you also still notice we still haven't really tested that moving average after breaking up to it, and that happens a lot, these long-term averages. Same thing on the 200-day moving average. We still haven't really tested that 200-day moving average after the golden cross, which again happens a lot in some of these examples here. And we've got this high PPO, and as I mentioned before, it's kind of hard to start a new intermediate run like we had from a PPO that's already so high. I mean, even this one here, after we had some transitions, even this intermediate run that we had, that you could say, this is actually one big long intermediate run, but you could say this stage of it right here started when the PPO was down just barely above zero. So now it's not the case. So it's kind of hard to get a new one going. This one over here started when the PPO was down at about 2.5. Again, we are already at 6%. It's a pretty significant momentum. It's hard to start a new run from these levels, and you got a transition candle this week, so that could lead to a bearish candle here, or 2 or 3 in the next week or two, going in again towards that 200-day moving average, which week by week is creeping up towards that 23% retracement, which suggests that again, whatever pullback we get is, if we get and when we get one, it's not going to be that big of it. It's not going to be a huge drop off. Again, I highly doubt we'll even get to the 38% Fibonacci retracement. Most likely will on the NASDAQ, though. That's a little different. You can see the 200-day moving average is actually still below that one. And again, very, very high PPO there, higher in the NASDAQ than we've seen. So it's kind of hard for the NASDAQ to start a new rally when it's already such strong momentum. And again, the transition candle suggests we could make a run back towards. He never did test the 200-day moving average after the golden crossover like we did in some of these other areas. Let's take a look at the 3 green arrow chart. Of course, on the S&P 500, we don't have 3 green arrows. We have the 2 reds. And they are starting to slow down their momentum. In the case of the MACD histogram, we're actually turning up a little bit here, but they're both still below the moving averages. We did bounce back above the 8-day moving average, so we'll see if that holds or not. Remember, if we get below the 17-day and that holds, then again, that's kind of what we're looking for to see if we're going to get this downward move or not. Let's take a quick look at some of these other oscillators here. The SPX, you can see we're above 50 but not above 60, so kind of in no man's land. Sucker zone is like what I like to call it. Around the midpoint of the CCI, we're not really above 100, we're not below negative 100 either, so kind of a neutral area there. And the directional movement index, which I spent a lot of time with on Friday's technical analysis class, this shows too that we're just not getting a directional move at all. Very flat directional indexes on both positive and negative, with a falling ADX. It's very, very low. So some pretty sideways action that I mentioned before, and you have to break 3430 on the SPX to the downside to get a directional move to the downside. You have to break above this kind of 3500, 3510 level on the upside. Anywhere in between, if we just stay stuck in that in between over the next week, then that's just going to be noise. We're not going to get a directional move one way or the other, even if it's this directional move towards support, until we break that level. You can also see too, from a Bollinger Band standpoint, breaking above that level would get you into the upper quartile of the bandwidth. Breaking below this 3430 would get us into the lower half and potentially below the top of the value area, and that'd be a little bit more bearish. But knowing all the support you have, it's not going to free fall here, more than likely. The Ichimoku cloud also suggests more weakness, as we're kind of been flirting with the cloud, and the prices can come down and still be above. There's not a whole lot of support holding up that red line here, so really decent opportunity. There's a pretty decent opportunity, especially staying below the green line there, for the price to stay, to have some weight above it, and to stay on a downward slant that we've had over this past couple of weeks. Let's take a look at the intraday volume. I actually finished the week on a pretty high note. But again, you can see, look at the sideways action. After Monday's move, look at the sideways action that we had. Up and downs all throughout the week on an intraday basis before finally closing the last couple of 10-minute periods here on a very, very strong note. But again, not a breakout note. So you've got this pretty, big volume node acting as a gravitational pull that, getting about 3,500 can break you out of it up to the top of this value area and beyond, and getting below these levels here would break us down and start heading low to 3430 would be the level, kind of the midpoint of the midpoint of this 4-week range, and then starting to fill in that gap below us down towards 335. You remember 335, 325 is where the 23% retracement level is. So breaking below these levels would start to move us towards the larger point of control on the 1-year chart, which while we're inside the value area, if we were to get inside the value area, that would be a pull, pulling us down towards it. Here, let's take a quick look at the volume today. We were well below average on the range and well below average on the volume. In fact, very, very, very light volume here. And that's okay. You can see the volume is relatively low. The ATR is relatively low, but not low enough to be entrenched in a bullish directional move. And you see that in the volatility index too. It's also declining, but not to even the bullish territory. It's still actually just barely, briefly pierced the neutral zone from the bearish territory, but we were in bearish territory for most of this week, and we'll see if like previous Mondays, we don't start off higher again and have a little bit of a bearish beginning of to the week. As you can see, for the last few Mondays, we've had jumps to the upside every time, all three of these Mondays here. So the VIX is relatively high. It's also, on an absolute basis it's high, on a relative basis it's high, and we all know why. So, and I expect that, something we brought up in the technical analysis class, that VXN, which is the volatility index for the NASDAQ 100, is really, really low levels right now. Very small range this month in October. Now the month's not over with, but keep in mind that we're going into the last week with a 5-point range in the volatility index, whereas last month we had a 15-point range. So very, very small range, and also on a relative basis, keep in mind that 5 points out of 33.45, which is the current level, is about 15%. If you were to go back over here to we had 2.93 points here back in November of last year, and we closed at 1486. You can see we had 19. That was 19%. So that's a really, really small range relative to how big the index is, how high it is. Last time that led to a jump. That's what you'd expect. That's the idea. When you have small dispersion or very little dispersion in volatility, it typically leads to a bigger one, to a bigger breakout type move. And right now, your bigger breakout moves obviously occur to the upside, and then we correct them back down to the downside months after that. So there's an opportunity here for, even if there's a long upper shadow eventually to come out of it, but a jump in volatility, if it doesn't happen this week, to make it a little bit bigger than starting in November, especially with the election, and getting a pretty decent sized potential jump in volatility coming out of that. All right, so to summarize the market outlook, again, things look pretty bullish, kind of up and down this week, but up and down in the sideways range, in a relatively sideways range for the longer term basis too. So we've kind of got a range of a high and a low that we're got our eyes on for breakout directional moves, with the expectation that more than likely we're going to break down to the downside if we repeat the precedent we've seen before for the weeks before presidential election, as well as what some of these indicators are telling us that we're really, really heavy right now in the short term, not the long term. Very big long-term tailwinds that can push stocks up higher, but in the very short term, volatility readings and other things tell us that things are a little bit heavy, and there's an opportunity for more of a pullback that maybe this little bit of a gamma exposure we talked about before helped us avoid that in September by the end of the month, that we might eventually get here at the end of October, or the beginning of November. So what do you think? Do you agree with that? Do you disagree? Comment down below in the comment section, especially if you disagree, and let me know what you're seeing or what charts you're looking at or indicators you're using that suggest why you're either a lot more bullish or a lot more bearish than I am. If you take a look at the sector performance, the biggest surprises to how things performed here this week, if I come down to October, and then we'll come over here to the 19th going into the end of the week. If you take a look at how things perform, check out some of the biggest surprises, and that's the fact that even with stocks down, especially the Qs, IWM was not down, small cap stocks weren't, and look how bearish bonds were. So bonds had a really, really bearish week on one hand. The dollar was really down significantly as well. Look at emerging market stocks. They had the best week by far this week. This is a really big part of our portfolio with the portfolio that we manage in our portfolio with ETFs. We have an allocation towards EEM that our market scholars know how important that is for us right now. And it's, again, has had a really, really good week. A lot of it because of the weakness in the dollar. But interestingly enough, it's not just weakness in the dollar. You notice you're also getting strength in bond yields moving up above 80 basis points for the first time in a while. In fact, if you take a look at the weekly chart, we got a green line, and we're that close to getting dark green shading on the weekly market forecast. So after being in this bear market since the fall of 2018, everybody knows here that's something we've been talking about for a long time. This kind of fake bear market that we were in. We might be turning it around here, and where we get a pretty decent move higher in yields, and we all know how that impacts things. From an interest rate sensitive sector standpoint, that'd be very beneficial for financial companies, and as long as the dollar itself also continues to show weakness, you see the big bullish pattern here on the euro that's continuing. That will be very bullish for dollar sensitive areas like industrials and materials, and to another extent energy, but right now energy's kind of got its own issues from a sector standpoint. You can see the market sentiment line here just barely getting above 50, so there's an opportunity here for the euro to be bullish for a while. Obviously that means for the dollar to be bearish for a while. Now let's translate what happened with the different asset classes into what happened with the different sectors. So let's go to, remember, weakness in the dollar, weakness in bonds, strength in international stocks, strength in small cap stocks. So let's take a look at how that played out here with the different sector rotation moves. So we'll come over here to the 23rd and then come to a 15-minute chart, and you can see after what was a pretty significant struggle for communication services, Facebook, Google, a lot of these companies having a hard time right now with Congress, with monopolies. They actually did the best. And interestingly enough, two interest rate sensitive sectors on both sides of that coin also did the best. Utilities, which is what you'd not expect in a rising yield environment, but a safe haven. Again, but you wouldn't expect small caps to lead and emerging markets to lead in a safe haven move, but that's what utilities is showing us. Financials is showing us that interest rates are rising, and you would expect them to do well too. Interestingly enough, energy went from the worst performing sector as of Thursday morning to the top performing sector by the end of the week. So very strong move in energy. In fact, by the beginning of Friday, it was the top performing sector for the week before it had some weakness to close it off. And look at the other end of the spectrum, the XLK, which has been the big winner. During any kind of intermediate pullback, you'd expect it to be one of the bigger losers, and you would also expect XLC to work its way back down and catch back down to it as well. And on the other hand, you'd expect staples and real estate to catch up to where utilities are. Without yields, financials will move a little bit higher. So, expect, this is kind of a 1 week phenomenon. I wouldn't expect the same kind of things to continue to occur if yields, the dollar, pull back a little bit. The euro US dollar pulls back along with the yields, which would impact some of these areas, as well as risk appetite as a whole pulls back, which would impact not so much technology. It's continuing its bearishness, but something that had such a strong week like communication services to catch back down, even consumer discretionary to catch back down to other consumer areas and other cyclical areas down here at the bottom. Alright, so for our trade idea of the day, I wanted to take a look at a stock that got its own overbought cluster, but with the intermediate line just barely getting into the reversal zone and beginning of a new intermediate, potentially the beginning of the intermediate rally. Very good sign for this financial company. Again, rising yields is a benefit as well. You can see from a 3 green arrow standpoint here. You obviously have 3 green arrows. We had 3 green arrows over here initially. Nothing real significant on the breakout on the volume yet to kind of tell us that this is going to be a breakout. You look at its DMI chart. We're not really getting breakout pattern. Oops, excuse me. We're not quite getting breakout patterns here yet. The positive hasn't really moved above 30. The negative has been below 20 this entire time, so we haven't really been too bearish, but not bullish enough either to really break out. And then you look at like other oscillators like RSI and CCI, and you're above 60 and you're above 200. So a pretty decent size move, and we were able to hold it. You look at the Bollinger Bands here, and you say, okay, well, we are breaking free potentially at the point of control, but we're still in the value area. I'm moving into a little bit of a gap, but still need to kind of make it a little bit bigger of a move to get above this 44 and 3/4 to really break out. And even then, you're going to meet up with some resistance up here at 50. So that kind of limited upside potential kind of leads me to think, okay, well, I want to do something bullish on this, but not too bullish because I'm kind of limited in the upside directional opportunity. So if I just sold at 39.5, bought the 37.5, I came over here and analyzed that trade. You can see that's what I did here. Position size for not a full position because it does have the earnings coming up, but then you see I'm getting a pretty decent reward, better than 50%, excuse me, 30%, which is the kind of minimum we look for on a bull put spread. So it allows us to be bullish, let it come back to the point of control even, and still not get out of it depending upon when it does that, and then see if we can stay above this level. Considering its implied volatility, it's a little bit relatively high in the 44s, but remember the market itself is also in the 30s, nearly high 20s. So everything is going to have relatively high implied volatility right now, which means nobody really does, unless you have own specific individual earnings announcements that can impact them. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments. Reply to anybody else's threads if you want. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Have a great rest of your weekend, everybody, and we'll see you all next time.